A property can be in covenant compliance and still be heading towards payment default. That sounds like a contradiction, but it is not. Covenant compliance means the loan is meeting its contractual ratios, debt service coverage at the threshold the lender requires, occupancy at the level the loan agreement specifies, reporting delivered on time. The loan on paper is performing. Payment default is something else. Payment default is when the borrower cannot or does not make the debt service payment when it comes due. It is a liquidity and cash flow crunch event, not a covenant event. These two can move independently. Here's a situation I have seen play out multiple times in this current cycle. A property is operating reasonably. NOI is in the range projected. The DSCR technically clears the covenant threshold. The lender is not flagging the loan yet. At the same time, the operator is burning through reserves. Insurance came in higher than underwritten. A major capital expenditure bill landed on your table. More tenants moved out than expected. The next quarterly debt service payment is due, and the cash to make it is not in the operating account. The DSCR did not fail. Liquidity and full cash flow did. This is why covenant compliance is not the same as deal health. The DSCR captures part of the cash flow, but it does not capture the full cash flow and the balance sheet. It does not show you what is in the reserve account. It does not show you whether the next capital expenditure bill or the next property tax payment is fully funded. The LP, reading the quarterly sponsor report, sees a compliant deal. But the reality, 3 months later, maybe a capital call or a pause distribution. The lesson is to look at a couple of things, not one. Look at the covenant metrics, of course, DSCR, occupancy, reporting, all of these matter. But also look at the liquidity position and the free cash flow. What are the reserves? What is the burn rate? What is the runway that the sponsor has to manage with the existing liquidity level? Good sponsors will answer that transparently. Those who don't will speak in general terms or may not even show you the full picture. That in and of itself is an answer. A deal can look compliant and be 3 months from a capital call. Compliance is what the bank measures. Continuity is what LPs need. If this was useful, subscribe and leave a comment. If you are reviewing a deal and want a second set of eyes, send me a direct message. I actually covered this exact subject in more detail in my last newsletter. If you'd like the link to it, send me a DM or comment below.